Okay, let's just jump right in. Picture this. You hit 65, and statistically, there's something like a 70% chance you'll need some kind of long-term care down the road. 70%. That's huge.
It really is a high probability event.
And then the cost. I mean, the numbers we're seeing, they're all over the place, but on average, what? $26,000, maybe up to $128,000 per year.
That's the range, and it's a staggering amount of money, a massive financial shock for most families.
Right, and most people just aren't ready for it. And the old answer, traditional long-term care insurance, well, it seems like for a lot of folks, that's either too pricey or just doesn't feel right.
Yeah, that perception is definitely out there.
So if that traditional policy isn't the only game in town, what else is there? What are the real viable alternatives for planning for this potential need?
That's exactly what we're going to unpack today. This whole deep dive is focused on exploring those alternatives to traditional LTC insurance, specifically here in the U.S.
And we've got a lot to draw on. We've looked at stuff from financial planners, insurance specialists, even legal angles on protecting assets, a bit of policy analysis too.
It was a pretty wide net.
Yeah, so the mission here is to kind of sift through all that and pull out the key strategies, from using your own savings, looking at your house, to these hybrid insurance things, and even government programs, trying to make sense of it all.
Exactly. It's about understanding the full menu of options, not just the one item everyone talks about.
Yeah.
Helping you figure out what paths might actually work for your situation.
Okay, so before we get lost in the options, let's just reinforce why this planning is so crucial. You mentioned that 70% number up front. That's from Health and Human Services, right? It keeps popping up.
It does, and it really drives home the point. This isn't some rare fringe possibility. It's likely for most people reaching retirement age.
And the costs again. It's just staggering. Can we put some more specific numbers on that just to make it real?
Sure. Even looking back a few years, say 2019, median monthly costs, and remember, these have probably gone up since then.
Right, inflation.
Exactly. So back then, basic homemaker services were around, what, $4,300 a month? A home health aide, similar, maybe $4,400. Assisted living, just over $4,000 a month.
Still thousands every single month.
And then you get to nursing homes. A semi-private room, median cost over $7,500 a month. A private room, closer to $8,600 per month.
Wow, so you multiply that by 12 and then potentially by several years.
And you see how those annual averages of $26,000 to $128,000 are absolutely realistic. It can just demolish savings. Decades of savings gone.
And here's the kicker, the thing I think trips a lot of people up: Medicare, our main health insurance for seniors. It doesn't cover this stuff. Right?
Generally, no. That's a huge misconception. Medicare is primarily for acute medical needs, hospital stays, doctor visits, short-term rehab after hospitalization.
Not the ongoing help with, like, getting dressed, eating, supervision.
Exactly. That custodial care, the non-medical help that makes up the bulk of long-term care needs, Medicare doesn't cover it. That's the gap, the big, potentially devastating financial gap.
And that gap is why we need a plan.
Precisely. But despite the odds, despite the cost, denial is a powerful thing. One planner in our source material said clients are often pretty much in denial.
Until maybe they've seen it firsthand, like with their own parents.
That's often the trigger, yeah. If you've lived through coordinating and paying for a parent's care, suddenly it becomes very real. Otherwise, the perception often sticks. Traditional LTC insurance is too expensive, maybe too complicated, maybe you won't even qualify.
It's tough thinking about needing care, losing independence, the cost. It's uncomfortable stuff.
Absolutely. But ignoring it, not having a plan, that could end up being the most expensive choice of all, financially and emotionally.
Okay, so let's pivot to the alternatives. If traditional insurance isn't the route you want to take, what's plan B or C or D? First up, using your own resources, savings, assets, your house.
Right, the most direct route is self-funding, just paying for care out of your existing savings and investments. If you've built up a significant nest egg, this is an option.
You could even earmark certain accounts. This is the long-term care fund.
Some people do that, yeah, mentally or actually setting aside specific assets. The big pro here is obviously flexibility, total control.
You decide where the care happens, who provides it, how much you spend.
Exactly. No insurance company rules or limits, just your budget. But, and it's a big but,
the risk of running out.
That's the major downside. Care can last a long time, years potentially, and depending on the level of care needed, you could burn through substantial wealth, maybe even everything you've saved.
And you might actually end up spending more than if you'd had insurance because you don't have that risk pooling effect.
That's a possibility highlighted in the research, yes. Plus, the fundamental question, can you realistically save enough? For many people, accumulating the hundreds of thousands, potentially millions, needed for extended care is just not feasible through savings alone.
What about stuff that isn't cash? Like you mentioned assets, selling things.
Yeah, that's another angle under using personal resources, selling non-monetary assets. Things of value you own besides your primary home.
Like what? An art collection, classic car, investment property.
Exactly. Stuff like that. You liquidate it to raise cash for care, leverages wealth you already have, just tied up in things rather than bank accounts.
Seems practical, but selling grandpa's classic car or the family vacation cabin, that sounds tough.
It really can be. The emotional attachment is a huge factor, a major con mentioned. These aren't just assets. They're often part of family history, full of memories.
Plus, the market for like collectibles, it can go up and down, right? Not as predictable as maybe stocks or bonds.
Volatility is another risk.
Yeah.
Definitely. You might need the money when the market for that specific asset is down. Adds another layer of uncertainty.
Okay, so let's talk about the big one for most homeowners, the house. Tapping into home equity. Our sources really emphasize this as a major potential funding source.
It often is the largest single asset people own. And there are a few key ways to access that equity for long-term care.
The most obvious, maybe the most drastic, is just selling the house.
Right. Selling your primary residence, you unlock all that equity you've built up over the years.
How does that usually play out in an LTC scenario?
Well, the money freed up could cover care costs, maybe for a significant period. It might make sense if you're planning to move into a care facility anyway, or if you're downsizing and the sale proceeds are substantial. Maybe you buy a smaller place and use the difference for care.
It leverages the asset, protects other savings maybe.
Potentially, yes.
Yeah.
If you don't have kids living with you, or if the house isn't suitable for aging in place anymore, it's a logical step for some.
But selling a house is a huge pain anytime. Doing it when you're also dealing with a health crisis and figuring out care.
That's the massive downside everyone points to. It's incredibly stressful, physically demanding, time-consuming, exactly what you don't need when you're vulnerable and potentially needing care yourself or coordinating it for a spouse.
In the housing market, you're subject to whatever the market conditions are when you need to sell.
Right. Market volatility is a big risk there, too. You might not get the price you expect or need.
So are there ways to get cash out without selling? What about borrowing against the equity, home equity loans, HELOCs?
Yes. Those are options 2 and 3 under using home equity. A home equity loan gives you a lump sum, you pay it back over time, usually fixed payments, secured by the house.
And a HELOC.
That's a home equity line of credit, more like a credit card backed by your house equity. You draw funds as needed, up to a limit, and pay interest on what you borrow, also secured by the home.
The appeal there seems to be getting cash while potentially staying in the home, right? Especially if you need in-home care.
That's a key advantage. You access the equity but don't necessarily have to move. And the interest paid on a home equity loan might be tax deductible, depending on how you use the funds.
Some people even set up a HELOC before they retire, just to have it ready.
That's a strategy you mentioned, yeah.
Yeah.
Secure the line of credit while your income is higher, then have it available later if needed. But there are catches.
Like qualifying. Income might be lower in retirement.
Exactly. Qualifying can be tougher. And you have to make those regular payments, either on the loan principal and interest or on the interest for the HELOC draws. That's a fixed expense in retirement.
And the biggest risk, because it's secured by the house.
Default. If you can't make the payments, you could face foreclosure, lose your home. That's the ultimate risk with these.
Okay, that brings us to the third home equity option, and maybe the most talked about and complex, the reverse mortgage.
Definitely complex and generates strong opinions. But important to understand, a reverse mortgage is basically a loan for older homeowners, usually 62 plus, who own their home outright or have a lot of equity.
You borrow against the equity, but you don't pay it back month to month.
Generally, no. The loan balance grows over time, the amount borrowed plus accrued interest and fees. It typically only becomes due when the last borrower dies, sells the home, or permanently moves out, like into a nursing home.
The most common type is the HECM, Home Equity Conversion Mortgage.
Yes, that's the federally insured version, which offers certain consumer protections.
And who qualifies? Is it like a regular mortgage, credit score heavy?
Less so on the credit score. It's more about being 62 or older, having sufficient equity in your primary residence, and demonstrating you can handle the ongoing costs of ownership, property taxes, homeowners insurance, basic maintenance, Social Security income often counts towards that.
How do you actually get the money? Lump sum.
You have choices, which is a plus. You can take a lump sum, receive scheduled monthly payments like an income stream, or set up a line of credit you can draw on as needed, or even a combination.
And with the line of credit, you only pay interest on what you actually use.
Correct. That flexibility is appealing. The unused portion of the credit line can even grow over time in some cases.
So how does this fit with paying for long-term care?
It's often positioned as a way to fund in-home care. If you want to stay in your house and bring caregivers in, a reverse mortgage can provide the funds to pay for that, potentially for many years, without requiring monthly loan payments out of your pocket.
That sounds like a big advantage, staying home, accessing cash tax-free.
Right. Other pros include eliminating any existing mortgage payments. The reverse mortgage often pays that off first. You keep ownership as long as you meet the loan terms, live there, pay taxes and insurance, maintain the home, and the HECM insurance provides peace of mind. Financial flexibility.
What? The costs. I hear they can be expensive.
They can have significant upfront and ongoing costs. Origination fees, mortgage insurance premiums for HECMs, servicing fees, closing costs, plus the interest accumulates. It's definitely something to compare carefully. Some feel the costs are too high.
And the big catch seems to be you have to live in the house.
That's a critical limitation. If your health declines and you need to move permanently to assisted living or a nursing home, the loan usually have to be repaid.
Which typically means selling the house.
Usually, yes. The house is sold, the loan balance, principal interest fees, is paid off, and any remaining equity goes to you or your estate. So it's not flexible if facility-based care becomes necessary.
How does it interact with government benefits like Medicaid? If you take out cash, does that count against you?
Good question. The loan proceeds themselves aren't usually counted as income, but the cash you receive and hold on to, say in a bank account, can be counted as an asset. If that puts you over the Medicaid asset limit, it could affect eligibility. State rules vary, so that's crucial to check if Medicaid might be needed later.
And comparing it to, say, traditional LTC insurance.
Well, LTC insurance pays benefits regardless of where you receive care home, facility, etc. And it doesn't use your house as collateral, so there's no risk of foreclosure tied to the insurance itself. Fewer financial strings attached to the home asset itself.
So when does a reverse mortgage really make sense for LTC funding?
Generally, it fits best if you plan to stay in the home long-term, like 5+ years. If you need funds while at least one spouse remains in the home, if you can afford the ongoing property taxes and insurance, and if you need care in the home. It's a tool for aging in place, primarily.
Okay. Shifting slightly, but still in this personal resources bucket. ABLE accounts, they came up. How do they fit? They seem more disability-focused.
They're definitely designed for individuals with disabilities, but they're a powerful savings tool with relevance. ABLE stands for Achieving a Better Life Experience. They're tax-advantaged savings accounts.
For people receiving benefits like SSI.
Exactly. Before ABLE accounts, someone on supplemental security income, for instance, could only have about $2,000 in assets total. Very limiting.
Incredibly low, so ABLE accounts change that.
Massively. An eligible individual can save up to $100,000 in an ABLE account without it counting against that SSI asset limit. That's a huge deal for financial security.
Wow. And contributions can come from anyone.
Yes, the individual, family, friends, up to the annual gift tax exclusion limit, and the money grows tax-free.
What can you spend it on?
A broad range of qualified disability expenses. Things like healthcare, housing, transportation, education, job training, assistive technology, personal support services, basic living expenses. It's quite flexible. And withdrawals for these qualified expenses are tax-free.
So it avoids that awful spend-down situation where people had to quickly spend money on things they didn't need just to stay eligible for benefits.
Exactly. It stops that. It allows people to save for their future needs, increasing independence and financial stability.
And the connection to long-term care.
While broad, many qualified expenses overlap with LTC needs, personal support services, home modifications, assistive technology. For someone with a disability who might face LTC needs earlier or differently, being able to save significant funds tax-free while keeping vital benefits like SSI and Medicaid makes ABLE accounts a really critical piece of their long-term financial and care plan. They can also complement things like special needs trusts.
Got it. Okay, that covers using your own money and assets. Let's move into insurance and these hybrid solutions. This feels like where things get maybe less familiar than just traditional LTC insurance.
Yeah, this is an evolving area. Hybrid policies, sometimes called asset-based or combination policies, are prominent here. They essentially bundle long-term care benefits with either life insurance or an annuity.
And these aren't just marketing terms, they have some official standing.
The legitimate ones do. They typically meet federal guidelines, often Section 7702B, which means they come with consumer protections and tax advantages similar to qualified traditional LTC policies. That's important.
How do you qualify for benefits? Same as traditional.
Yes, generally the same triggers. Needing help with usually 2 or more activities of daily living, ADLs, bathing, dressing, eating, transferring, toileting, continence, for an expected 90 days or more. Or needing substantial supervision due to severe cognitive impairment, like Alzheimer's.
And the payout, how does that work?
2 main ways. Some work on a reimbursement basis. You submit bills for covered care expenses, and they pay you back up to your monthly policy limit.
Okay.
Others offer a cash indemnity benefit. Once you qualify, they send you a predetermined cash amount each month, regardless of your actual expenses.
That sounds more flexible. You could use it to pay a family member, maybe?
Potentially, yes. Cash benefits offer more freedom in how the money is used, which many people prefer.
Our research broke these hybrids down into 3 main types. Can you walk us through those?
Sure. The first type is basically a life insurance policy with an accelerated death benefit rider specifically for long-term care.
So you're tapping into the death benefit early.
Essentially, yes. It's usually one pool of money. You accelerate a portion of your death benefit to pay for LTC needs. The amount you can access might be capped, maybe paying out 2% or 4% of the death benefit per month. Whatever death benefit you don't use for care still goes to your beneficiaries, tax-free. This type generally offers the least amount of dedicated LTC funding.
Life insurance first, LTC second. Got it. What's type 2?
This is where you often see more robust LTC coverage. It's called a linked benefit life insurance policy, sometimes with an extension of benefits rider. Here, you typically have the life insurance death benefit plus an additional separate pool of money specifically earmarked for long-term care.
So 2 pots of money.
Kind of. The accelerated death benefit might cover the first few years of care, and then the LTC extension kicks in for potentially several more years.
Yeah.
Some even offer unlimited lifetime LTC extensions now. These policies usually prioritize the LTC coverage while still guaranteeing a death benefit if the LTC isn't fully used. Premiums are typically guaranteed level 2.
Okay, that sounds more substantial for LTC. And the third type involves annuities.
Right. A linked benefit annuity policy with an LTC extension. You start with an annuity contract value. If you need LTC, the policy pays out a monthly benefit calculated as a multiple, say, double or triple of that annuity value spread over a set period. Or again, some offer unlimited LTC benefits.
How are the benefits taxed?
The LTC benefits paid out from a qualified linked benefit annuity are received tax-free. If you just take money out of the annuity for non-LTC purposes, or the remaining value passes at death, the gains are taxed as income, like any deferred annuity. But the LTC payouts themselves get favorable tax treatment.
Any other features of the annuity link type?
Underwriting might be a bit easier than for traditional LTC insurance sometimes. And a big plus is you can often fund these using a 1035 tax-free exchange, rolling money over from an existing non-qualified annuity or the cash value from a life insurance policy without triggering taxes on the gains immediately. It's a way to reposition assets specifically for LTC.
Repositioning assets. Interesting. Now, there was a big warning flag in the research about something that sounds like LTC coverage but isn't: chronic illness riders.
Yes, this is absolutely critical to understand. These chronic illness riders are often added to life insurance policies, sometimes called living benefits, but they are not the same as qualified long-term care insurance riders or policies under Section 7702B.
What's the key difference? It sounds similar.
The trigger for benefits is usually much stricter and narrower. A chronic illness rider typically only pays out if you are diagnosed with a condition that is expected to be terminal within a certain time frame, like 12 or 24 months.
So if you need help because of severe arthritis or Parkinson's or Alzheimer's, but you aren't certified as terminal,
the chronic illness rider likely won't pay anything. It doesn't cover the typical non-terminal long-term care needs that most people experience. They also lack the consumer protections and guaranteed tax-free status of qualified LTC benefits. It's a frequent point of confusion, sometimes misrepresentation.
Wow. So you could think you're covered, but you're really not for the most common LTC scenarios. That's risky.
Extremely risky. You have to read the policy details very carefully. Look for the ADL and cognitive impairment triggers, not just terminal illness language. Work with someone knowledgeable who understands the difference.
Good warning. So when looking at true hybrid LTC policies, what are the key things to ask about?
Dig into the details. How exactly is the LTC benefit structured? Is it truly an additional pool, or just accelerating the death benefit, our benefits paid cash or reimbursement. What's the elimination period, that waiting time before benefits start?
Inflation protection seems crucial too. Costs go up every year.
Hugely important. Does the policy offer meaningful inflation protection so your benefit keeps pace with rising care costs? Ask about how unused benefits grow, if there are options for couples to share benefits, and definitely confirm if the premiums are guaranteed never to increase.
That guaranteed premium is a big selling point for hybrids, isn't it? Compared to traditional LTC, where premiums can sometimes go up over time.
So probably the number one advantage people focus on. Premium stability. Other pros, sometimes easier underwriting than traditional LTC, and the guarantee that someone gets the benefit. Either you get LTC funding or your heirs get a death benefit or annuity value. Nothing is lost if you don't need care.
It's like a return of premium concept.
Exactly. And the qualified LTC benefits are tax-free. It can be a good fit for assets you have earmarked for inheritance, but want to have available for LTC if needed.
What are the downsides then?
Primarily the upfront cost. Because you're buying two benefits in one package, LTC plus life annuity, the initial premium is usually higher than buying a standalone traditional LTC policy with the same LTC benefit amount.
You pay more for that premium guarantee and the death benefit annuity value.
Right. Also, the tax deductibility of premiums might be less favorable or more complex than for traditional LTC policies. And the amount of LTC coverage, especially with simpler rider designs, might be more limited than what you could get with a dedicated LTC policy for the same premium.
Okay, that covers hybrids. What about short-term care insurance? That came up too.
This is a niche product designed to cover LTC-type services, but only for a limited duration, usually a year or less.
So cheaper than full LTC insurance, I assume?
Generally, yes, more affordable premiums. Another potential plus is that benefits often start quickly, maybe with no elimination period or a very short one, unlike the 90-day wait common in many LTC policies.
And they can pay alongside Medicare.
That's a unique point mentioned. They aren't typically prohibited from paying benefits, even if Medicare is also covering some related skilled care, which traditional LTC policies usually can't do. And given that a significant chunk of LTC claims, maybe around half, actually last less than a year, this could cover the need for many.
But the big if is, what if you need care longer than a year?
Exactly. That's the limitation. If your care needs extend into multiple years, which is also very common, a short-term policy runs out. It doesn't provide that long-duration protection you get from traditional policies offering 2, 3, 5 years, or even lifetime benefits.
Then there's critical illness insurance, or CII. How does that fit? It sounds more like health insurance.
It's sort of supplemental health insurance. CII pays a lump sum cash benefit if you're diagnosed with a specific covered critical illness, like heart attack, stroke, cancer, organ transplant, things like that.
A defined list of serious conditions.
Right. The pro is you get cash, no strings attached. You could use it for medical bills, deductibles, lost income, maybe even adapting your home or paying for some temporary care related to the illness.
But it's not really LTC insurance.
Not at all. That's the major con. It only pays for those specific acute illnesses listed. It won't cover ongoing care needs due to chronic conditions like arthritis, diabetes, dementia, unless that condition directly results from a covered critical illness diagnosis. And benefit amounts are often much smaller, 10K, 50K is common, than what long-term care can cost. It's a different tool for a different risk.
Okay. And lastly, in this insurance-ish category, HSAs, health savings accounts. We touched on them with high deductible plans.
Right. If you have a qualifying high-deductible health plan, you can contribute to an HSA. The big draw is the triple tax advantage. Tax deduction going in, tax-free growth, and tax-free withdrawals for qualified medical expenses.
And some LTC costs qualify.
Yes. Qualified long-term care services and even premiums for qualified LTC insurance policies are considered eligible medical expenses for HSA withdrawals. So you can use those tax-advantaged dollars.
That's great flexibility. Use it for regular health care or LTC if needed.
Exactly. If you don't need it for LTC, the funds are still valuable for other retirement healthcare costs, or even non-medical expenses after age 65, though those withdrawals would be taxed like regular income then.
But the catch is maybe not being able to save enough for major LTC needs. Contribution limits apply each year.
That's the main limitation for using HSAs as your primary LTC funding source. The annual contribution limits might not allow you to build a large enough balance to cover years of expensive care. It's a fantastic supplemental tool, but probably not the whole solution for most people's potential LTC costs.
Makes sense. Okay, so we've covered personal resources and various insurance hybrid approaches. The third big area involves government programs protecting assets legally and maybe community support. Medicaid looms large here.
It really does. Medicaid, the government health program for low-income individuals, is actually the single largest payer for formal long-term care services in the U.S., over half the total bill nationally, and covers a majority of nursing home residents.
But you can't just sign up. It's means tested, right? Strict income and asset limits.
Extremely strict. That's the core issue. To qualify, you generally have to have very little income and very few countable assets. For many middle-class folks, that means they'd have to spend down almost all their life savings paying for care out of pocket before Medicaid would step in.
That sounds harsh, depleting everything you've worked for.
It is a harsh reality, which leads to Medicaid planning. This involves using legal strategies, usually with an elder law attorney, to structure assets and income before needing care, or sometimes even when care is imminent, to meet those strict Medicaid limits while trying to preserve something.
What kinds of strategies are we talking about?
Things like setting up specific types of irrevocable trusts, Medicaid Asset Protection Trusts, or MAPTs, where you give up control of assets placed in the trust, using special Medicaid-compliant annuities to convert countable assets into an income stream, strategic gifting or transferring assets, but being very careful about the look-back period.
The look back, what's that?
Medicaid looks back, typically 5 years from when you apply, to see if you gave away assets or sold them for less than fair market value to try and qualify. If you did, they can impose a penalty period where you're ineligible for benefits, even if you meet the financial limits now.
Wow, complicated. And it sounds like you lose a lot of control.
You do lose control with tools like irrevocable trusts. And the spend-down requirement itself is a major con for many, potentially leaving nothing for a spouse or heirs. Plus, relying on Medicaid might limit your choices. Not all facilities accept Medicaid, or they may have waiting lists or offer different amenities for Medicaid residents.
Is there any way to bridge private planning with potential future Medicaid needs? We mentioned partnership plans earlier.
Yes, the Long-Term Care Partnership Program. This is a collaboration between states and the federal government designed to encourage people to buy private LTC insurance.
How does it encourage them? What's the incentive?
It offers asset disregard for Medicaid eligibility. It's usually dollar for dollar.
Right.
For every dollar your qualified partnership LTC policy pays out in benefits, you get to keep an extra dollar of assets above the normal Medicaid limit if you ever need to apply for Medicaid later.
Okay, give me an example.
Say the normal Medicaid asset limit in your state is $2,000, and you buy a partnership policy that eventually pays out $150,000 for your care. When that policy runs out, if you still need care and apply for Medicaid, you'd be allowed to keep $152,000 in assets, $150,000 plus the normal $2,000 limit, and still qualify.
So it protects those assets from the spend down.
Exactly. It protects them from being spent down to qualify for Medicaid, and usually also protects them from Medicaid estate recovery after you pass away. It's a significant asset protection feature.
Are these partnership policies available everywhere?
In many states, but not all. And the specifics vary. The amount of required inflation protection might differ based on your age or the state. Rules about reciprocity, whether your policy bought in one state will be honored if you move to another, also differ. You need to check your state's specific partnership program rules.
And the policies themselves. Are they special? More expensive?
The cost is like any LTC insurance, depends on age, health, benefits chosen. Comparison shopping is key. To qualify as a partnership policy, it has to be specifically filed and approved as such by the state insurance department and meet certain criteria, often including a specific type of inflation rider. It's not automatic. You need to make sure you're buying a policy designated as partnership qualified.
Got it. Okay, moving away from formal programs, what about just relying on family? That seems like the default for many.
It is incredibly common. Spouses, adult children, other relatives providing unpaid care. It's the backbone of long-term care in the U.S., really.
The upside is care from loved ones, familiar surroundings.
Absolutely. Emotional support, comfort, connection. Those are invaluable. But the downsides for the caregiver are enormous and often overlooked until it's too late.
Like the stress, burnout, financial strain.
All of the above. It requires total commitment, realistic expectations from everyone. It's physically and emotionally draining. Caregivers often have to reduce work hours or quit jobs, impacting their own finances and retirement savings. It can strain even the strongest family relationships.
And demographics are shifting, right? Smaller families, more people working.
Yes, the pool of available family caregivers is shrinking, which makes relying solely on family an increasingly precarious plan for the future.
Are there other, maybe community-based models? Co-housing came up. What's that about?
Co-housing is an interesting intentional community model.
Mm.
Often groups of seniors, but not always. People live in private homes but share common spaces and actively participate in managing the community. It fosters mutual support.
Like an old-fashioned neighborhood almost.
Kind of, yeah. Bringing back that sense of looking out for each other. In terms of LTC, some co-housing communities specifically plan for aging in place.
How? Do they provide care?
Not directly like a facility, but they might facilitate it. For instance, a community could collectively hire caregivers who work on-site, assisting multiple residents as needed. This can be more economical than each person hiring their own private caregiver.
So potential cost savings plus that community support. Aging in place.
Those are the big pros. Better quality of life through social connection, readily available help from neighbors, potentially lower costs than assisted living. Savings from downsizing homes often contribute too.
Any drawbacks?
Finding the right fit can be hard. It requires a certain mindset. They aren't always heavily regulated. And while mutual support is the goal, complex care needs could still exceed what the community structure can handle. It's not a guaranteed solution for everyone.
Okay, just briefly, let's touch on the bigger picture, the policy context. Why is all this individual planning so critical in the U.S. compared to elsewhere?
Because the U.S. really stands out for not having a comprehensive, universal national system for financing long-term care, unlike many other developed countries.
We rely on that patchwork. Medicare for short-term, Medicaid for the poor after spend-down, private insurance for those who buy it, and family.
Pretty much. That leaves huge gaps and puts immense pressure on individuals and families, which is why states are starting to experiment.
Like Washington State's public LTC insurance program, funded by a payroll tax.
Exactly. That's one example. Hawaii has programs supporting family caregivers. Maine debated universal home care. States are trying things because there's no federal solution.
And internationally, the models are different.
Very different. Our sources mention categories. Means tested like the US and UK. Social insurance systems like Germany or Japan, funded by mandatory contributions, much broader coverage. Universal systems like in Scandinavia, tax-funded, available to all based on need, often focused on home care, and hybrid systems like France.
Reflects different choices about who pays and who's covered.
Completely. Different societal values about responsibility for elder care. The U.S. system's fragmentation and emphasis on individual family responsibility just makes personal planning absolutely essential.
Wow. Okay, that definitely puts it all in perspective. We have covered a ton of ground here, from using your savings, your house, navigating these really complex hybrid policies, understanding Medicaid and partnership plans, relying on family, even community models like co-housing.
It's a lot to consider.
Yeah.
But the absolute core message, the main takeaway, has to be, you need a plan. Period. Hoping you won't need care isn't a strategy. Denial is not a plan.
Right. But the good news is it's not just traditional LTC insurance or nothing. There are many paths.
Many paths. And there's no single best answer. It's not one size fits all.
It depends completely on your situation, your money, your health, family, what you want your care to look like.
Exactly. It's deeply personal. The right approach for you might be a combination of several things we've talked about.
And using tools or working with professionals can help sort through it. Financial planners, insurance specialists, maybe elder law attorneys.
Absolutely essential. Trying to navigate this alone is incredibly difficult. Getting expert guidance tailored to your specific numbers, your goals, your concerns, that's key to building a realistic plan. And talking about it.
Communicating the plan to family, that seems huge. Avoid surprises and stress later.
It's critical. LTC situations are emotional enough without adding financial uncertainty and disagreements about what mom or dad would have wanted. Having a plan, discussing it openly, it's a gift to your loved ones.
So really, exploring these alternatives, making a plan, it's not just about money management, it's about ensuring you have choices later on. Peace of mind, dignity.
Well said. It's about having control over how and where you receive care, should that time come.
So, as you, our listener, think about everything we've unpacked today. Self-funding, home equity, hybrids, government programs, family, community. Which of these approaches, or maybe which combination, resonates most with how you envision your future? What feels like it aligns with your goals for aging well? And maybe more importantly, what's the very first concrete step you can take, maybe even this week, to start turning that vision into a solid plan?